You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, I think it's official. We're in the heart of earnings season. We are taping Options Playbook Radio. It is a Wednesday. The markets are closed. It's the 24th of July. We have major earnings that are coming out. As we speak, Facebook is just announcing earnings. We hear Tesla's going to be announcing today. At the end of the week, we have Google announcing. We have Amazon announcing. Two of our most talked about stocks around earnings, I would think, and it's mainly because of the share price. You have Amazon and Google, both of them over $1,000. You know, Amazon is actually closed today at $2,000.81 is where the close was for Amazon today. It was up $6.32. And then we had Alphabet, or better known as Google, that closed at $1,139.73, down $8.32. Now, these two stocks are one of the more interesting around earnings, and part of the reason why is they usually announce on Thursday after the close. So here's the scenario with these two underlyings, and we're going to look at trades in both of them today. But here's the scenario is that you have extremely high-priced stocks which add premium to just simple at-the-money option contracts. And then, to go along with it, you have earnings, and that adds implied volatility, which also adds premium. And one thing that has to happen is there's one day for the July 26th expiration, the Friday expiration, to live. Why? Because they announce on Thursday after the close, and you have one day to trade. What has to happen to all that premium in those option contracts? Well, it can't live past Friday. So the premium's there because the price is there and the event is there, but it has to go away in a day. That always makes an interesting trading scenario. So to be blunt, or to cut to the chase, if Google and Amazon announced on Monday, it would be a little bit less interesting to trade them. Why? Because that premium has 4 days to live, 4 trading days to live, Monday, Tuesday, Wednesday, Thursday, Friday. So because of that, it has 4 days to live. So you have Tuesday, Wednesday, Thursday, Friday, and in an expensive stock like Amazon or Google, that means that there's just still going to be a ton of premium. So you're still trading the premium just as much as you're trading the actual market on Amazon and Alphabet. All right, which I'm going to call Google going forward. So let's cut to the chase because we've got a lot to talk about today. One of, as you might know from listening to Options Playbook Radio, we like to talk about a lot of different butterflies on the show. and specifically around earnings. And one of the things that's great about a butterfly is that if you're correct on your forecast and it goes to your short strike, basically exactly where you want it to go, you want implied volatilities to come in and you want time decay to happen, because you're selling two option contracts, and if you're correct on your forecast, they're going to be at-the-money option contracts. We would need that time premium to be gone in order for the butterfly to start maxing out or starting to pay you for being correct on your forecast. The only way that you can make the maximum is if the at-the-money option contracts basically have zero time premium in them at all, and your forecast is correct. The stock actually stops right there. So good luck with that overall. But I think you understand the concept. So we're going to look at butterflies in both of these underlyings. And by setting up the trades today, and once again, I want to emphasize that on Options Playbook Radio, nothing is meant to be a recommendation. We're just trying to learn. And I also like to state is we never have an opinion on direction. We're looking at scenarios where this strategy might be better than that strategy, and we're always just looking to paper trade them so that we can learn about option pricing just as much as we learn about just the strategy overall. So with that said, I think we're going to start with Amazon today. The trades that we're going to look at, a good old butterfly is wonderful if you're going to be correct on your forecast, but one of the things about a butterfly is that you do pay for it. If you do a standard 10-point wide butterfly, pay a net debit. If it doesn't land within your long strikes of your long butterfly, well, you're going to be out whatever debit you paid. So a lot of people like to try to find interesting ways to do butterflies for a net credit. And that's the trade that we're going to look at today. We're going to look at doing a skip strike call butterfly, and we're going to start with Amazon, and then we're going to look at one in Google. And that's going to be it for the show today. They're going to be announcing earnings tomorrow after the close. And tomorrow, the date would be the 25th of July. And today we're taping on the 24th, and the markets are closed. So here we go. Let's get to the first trade. All right. I guess we'll just set it up. And the way that we look to set it up, it's usually a fairly standard format in that if you're looking at anything around earnings, you want to look at what the long straddle is trading for. And basically that's a line in the sand. That's kind of the over-under, if you will, on what the marketplace thinks the stock can move after earnings. And if you think it's going to move more, you do a strategy that you obviously think it's going to move more. If you think it's going to move less, you do a strategy that will benefit if it moves less. But it's really the line in the sand. Marketplace is saying this movement is possible. So Amazon, you can't get more at the money, really. 2,081. So we're going to look at the 2,000 call, the 2,000 put, looking at buying both of them. And the midpoint of that trade is $75.78. So it's not an exact science. So we're just going to call it 75. And then when we do that, I always like to look on the skip strike. You have a little bit of concern if it really gaps open. That's where your risk is. It's above and beyond. So I'd like to get as far away from the actual expected move and still try to get the trade done for a net credit to the account. So if you take 75, the expected move, and you divide that by 2, you come up with 37.50. You add that to 75, and we're talking about $112, $112.50. If you want to be exact, we'll call it $112. We're going to be looking at strikes around $112 away from where the current stock price is at. And with it being at 2,000, that's pretty simple. It's going to be $2,112 is about where we want to be. It's going to give us a little bit of protection because we are looking for a very big move on the upside before this trade starts working against us. So the trade would then be using the nearest term expiration. We're trading these for a specific reason in that they have 1 day to live. Would be buying the July 26th option contract, 1,110 strike call. We'll go and then sell 2 of the 1,120 strike calls, And then we're going to skip the 1,130 and buy the 1,140 strike call. Now, if I do all of that, right now the markets are closed, but it's showing me a midpoint price of 38 cents to the account. So, what are we doing with a skip strike butterfly? Why is this butterfly done for a net credit to the account? By skipping the 2,130 strike call, not buying it, you're actually embedding a credit spread into the butterfly. And if that credit is large enough, that can pay for the net debit of the butterfly. And in this instance, it is. So that's really what you're doing, which also means that there's a 10-point credit spread basically embedded in the butterfly, which has to be accounted for. So you are adding a margin requirement onto your entire position, and that would be the 10 points. So for every 1 by 2 by 1 butterfly that you're doing, you're going to have a $1,000 margin requirement minus the net credit brought in, which is $38. So you can use that on your margin requirement, but obviously it's not really enough to mention. It's $38 on a $1,000 requirement. Now, with that said, here's the good news about the whole trade. If the market goes down, if it stays flat, if it only goes up the expected move, 75 points, all of those scenarios means that the option contracts are just going to expire worthless. And if you do it for a net credit, you receive that net credit to the account. It's that simple. So if I'm doing this type of trade, I don't have a high probability of it getting to the 2,120 strike call, the ideal scenario, by the close on the Friday expiration. It's a low probability of it getting there. But if I'm wrong, I just make 38 cents or $38 for every butterfly that I put on. But if I'm right, I can make $1,000 on each and every trade, which is my total risk. So it's an interesting trade. It's not one that you would expect to make money time and time again. It is a limited risk trade, but it's a scenario. The only scenario where you really get killed is if Amazon opens up basically double what the expected move would be. And in this instance, you got to go all the way up to 2,140. Double the expected move would be 150 points. So we're talking about 140 points versus 150 points. And it really needs to do that on the open or right away. Why? Well, I can trade out of the position. If the market opens up 100 points and starts going towards my short strike, well, I can just trade out of it. So it's interesting to do a trade where there's really only one scenario that absolutely kills you on the trade when you put that trade on. Now, all that being said, whenever you have those type of odds, it's a lot of times hard to actually make money on that trade too. You're going to make the 38 cents, which is basically a little bit more than what your commissions are going to cost at Ally. We do pretty well as far as commissions, being a lower cost commission provider. But with that being said, it's still $38 for every 1 by 2 by 1 that you do, and you have a $1,000 margin requirement. Okay, so Amazon, skip strike butterfly. They announce earnings on July 25th after the close. We're going to buy the July 26th expiration 2,110 strike call, sell 2 of the 2,120 strike calls, and buy 1 of the 2,140 strike calls for a net credit to the account of 38 cents. Now, Google announces on the same day, or Alphabet, if you will, and we're going to use the exact same scenario on Alphabet. Now, one of the things about that stock is that at this point in time, Alphabet is quite a bit lower than Amazon. Amazon's a $2,000 stock. Alphabet, I'm just going to round off here, closed at $1,140 today. They're going to be announcing earnings at the same time, Thursday after the close. The straddle is $53.40 if you bought the 1,140 strike put and the 1,140 strike call. you would pay $53.40. We'll round that up to 54. You take 54, you divide that by 2, talking 27. 27 plus 54, where are we going to look to start? 81 points above where the current marketplace is at, somewhere around there. Like I say, this isn't an exact science. So if we do a similar skip, strike, butterfly in Google for all the reasons that we would do one in Amazon, we're looking at buying the 1,215 strike call, selling 2 of the 1,225 strike calls, and then skipping the 1,235 call and buying the 1,245 call. Now that's done for a net credit of 35 cents. Now I find that interesting that we're applying the same type of formula, the same type of outlook, and on this underlying, it's going to be done for a 35-cent net credit. Now, question would be, if you're going to do one, which one would you want to do? Well, honestly, I think I'd rather do the Google, and here's the reason why. Is we're still doing 10 points wide, and that's part of the rationale behind me introducing this. I don't care about the underlying stock. That's not why we're talking about this specific trade, but I do care that Google is a lot lower price, and I can get it done for about the same credit. I'm applying the same formula, the same logic, but we're doing this 10 points on a 1,000, 10-point wide butterfly, on a $1,040 stock is a higher percentage, if you're correct on your forecast, than 10 points on a $2,000 stock. In other words, that takes more movement inside that range for you to make that maximum. In other words, if you're doing this trade and you're talking about making 10 points in the Google on the lower price stock, I'd rather do that than on the Amazon. So just interesting scenarios. These are great paper trades to watch. You'll learn a lot about the pricing of options if you just follow them throughout the day. So Friday is going to be a very interesting day to be around the markets and watch what's going on. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.